It is January 1st, 2024, and this is our Insider Access Annual Outlook. And I'm glad that everybody could watch this, insiders and non-insiders, because it allows me to wish all of you a very happy, healthy, and prosperous 2024. So with that said, let's get started. So of course we are in 2024, and I'm going to start. This is just a quote that some robot mentioned: luck is fleeting, skill sets are not. And before we get started, I just want to reiterate what you've seen from me throughout the years that I've been on X and public facing is that I explain in detail my thought process and why we're going to see exactly what we do. And when I say luck is fleeting, when it comes to the world of investing, you want to be skilled, not lucky, because luck runs out, right? And so you hear a lot of people do really well and they take guesses, and this furu and that furu made a guess, and no one ever explains their ideas. It's something really simple, like here's a breakout because here's a line on a page. Luck runs out, and those people tend to disappear. They're not long-term wealth builders. They just got into it like a casino. But when you have a skill set, that doesn't run out. And if you look at any professional who is good at what they do, it doesn't matter what you do. You're an engineer, you're a nurse, you're a doctor, you're a carpenter, you work on autos, anything. If you're crossing your fingers to get lucky, that means you're not skilled. When you're really good at what you do, you actually don't think about, well, I hope I get lucky and repair this car properly. I hope I'm lucky and I treat this patient's infection properly with the right drugs. You don't do that. They're not thinking about luck because they're skilled. So the more you think about luck, it tends to mean that you haven't developed your skill set. So understanding the markets isn't a matter of luck. And so I want to start with a Q4 Insider Access recap. And this is great because it's good for insiders and it bridges to where we're going. But for all of you who are non-insiders, take a second. We'll go through this, and it lays the foundation for what I just discussed, that it's not about luck. Don't wire your brain to be like, cool. What's the next pick? That sounds more like a DraftKings selection for sportsbook betting. And if that's what you're into, you should do that. But don't pursue working within the markets, right? And even if you work on sports, do it from a skilled perspective, right? But if you want to understand, then you will get better at it. Like I said, think of a professional in any space. I don't care what you do. You're not sitting around crossing your fingers hoping for a lottery ticket. And remember, 99.9% of lottery tickets end up in the garbage. So in 2024, I projected that in the Q4 projected that the Feds would pause. In fact, I'm going to bring in some screenshots from outside the presentation. Here was a note saying that the Feds should have paused long ago, but will, all else equal, next meeting, right? And this was as far back as May. And that proved to be rather accurate. The Feds paused. How would I know that otherwise? Some of the world leading economists got it wrong. Some of the top people in the market got it wrong. Then I said they'll probably resume. And after that, with an insider access, we were able to capitalize on the Feds pausing. So you might be wondering, okay, great, you can be an economist. Well, what does that mean? Well, I projected that the 10-year yields would roll over, and so would the US dollar. So the yields coming down takes pressure off the markets, allows equities to rally. So understanding what was happening in the macroeconomy and with the Feds and the rates, and predicting it well in advance. And I was telling insiders who were watching this, and you saw my post on X as far back as May, I was saying that they will pause. And right now, the markets don't believe that. But when they start to believe that, they will catch up, right? And so what we saw is that the Feds did indeed pause. And I'm going to bring over a chart here. Like I said, I'm going to go in and out bringing things onto the screen because I like to qualify what I say and bring in some of the charts that we shared. And so here's a chart, right? And if we look at the TNX, right, this represents the 10-year yield. And this is the beginning of November. And you saw that I said they would begin to roll over. That means go down come November. Well, look, we peaked in November almost perfectly. It missed by a little bit, right? Here's the beginning of November. And it's just been a straight shot down since then. I highlighted this because I said that it's likely to see some big action there to break through. And of course, we gapped. And what did that do? That corresponded with the markets taking off, because as we see the yields come down, the markets took off. So let's get back to our presentation, right? And so that was what we saw. We projected the US dollar and the 10-year would come down, and that's a tailwind to the markets. When I say tailwinds, it's something that helps markets and stocks go up, take off, right? There's a reason that we had bearish trend as the Feds raised rates. And when money is more available, stocks go up. That's how it works. And we're going to talk about that more as we go on. We projected that the battle against inflation had already ended and that CPI, PCE, and markets would catch up. I just talked about that. We saw that. And the rally that we saw in the S&P 500 over the last couple of months was the markets absolutely catching up to this reality. everybody took it as, oh, it's a big surprise. But within insider access, and I put everything on the record, I was talking about this as far back as May and projecting that by November, we'd see our rollover. So that's what we see here. Notably, our big bullish ideas in Q4 were small caps. That's IWM. That was the focus for December. That was the number one call out. I said this is our call out of the month through December. I reiterated it over and over again. And if you scroll my feed on X, you'll just see countless insiders mentioning, thank you, did amazingly on IWM. Oh my God, IWM is taking off. This has been such an amazing play. So I'm going to actually pull up one of the images that I shared over and over again. And this was it. This was IWM. This is where we entered. This is the beginning of December. This was the ideas opening. So I shared the idea here. This is the beginning of December. I said, we are taking off right here. Back here is November, and then the beginning of December. And since then, absolutely take off. And I said, not to fear these tops, right? Because you'll hear some people who don't understand anything about stock markets, don't understand anything about equity, finances, economics, and they'll just say, oh, it looks like it topped here, so it will top again, right? Which is a very strange way of looking. It's so in a silo, as though the markets adhere to a pattern that you see, right? Sometimes there's technical analysis to be made, but that had nothing to do with what was happening. We had something extraordinary happening from an economic standpoint. The end of the most aggressive rate hike cycle in decades. And what do we see? This was the idea. So that's a 1 month performance. Swing trade did phenomenally, right? Some consolidation, more moves up, and I continued to reiterate. So this wasn't just to set it and forget it, cross my fingers, and don't mention it if it doesn't work out. Every other day I was saying, hey, if you haven't entered, this is the idea. This is the idea. This is the idea. Reiterate. IWM. We also were really big on gold. Gold absolutely exploded. So I'm going to bring up the charts here. Again, this is just our recap. Gold did fantastic through the month, and we have so many different price points. And these, of course, correspond to different items where we have entry points. So here we see into December, gold. We'll get a better knock on this. So this was one entry idea. We were actually at late November. And then we had another re-entry idea as gold broke up. And gold has just done phenomenally. Actually, circulated a chart showing that the idea appreciated 1,200% in just over a week based on the options that we were looking at. And Bitcoin has been huge. Everybody knows. I have a video that I put out where I show the entry idea that we had for Bitcoin at 27,500. And since then, we haven't had an exit just yet. Bitcoin at 43,000. Google has been a big idea. And Meta. Meta was actually, that you'll see right here, our bull case of the year for 2023 was actually Meta. And what's funny about this, and we talked about it all through the year within Insider Access, people enjoyed this, that was actually our bearish case of 2022. It was the stock I was most bearish on in 2022, and it was the stock that I was most bullish on. So it shows that you could pivot and be agile, and that's important, right? You're not in love with the stock, I'm not married to it. I don't work for Mark Zuckerberg or Meta. My duty is to analyze what we have in front of us, what changes are occurring in the company, where there's opportunity, where there's headwinds and tailwinds. So here we go. Funny enough, if we were looking at last year, and this is a chart I remember circulating, we talked about in the beginning of 2023, I said this was our most bearish stock, and this is the move that Meta made last year. And this is January of 23, and the performance to December 2023. So Meta was our number one bull case for the year this year for a variety of reasons. There were changes that we wanted to see within the workplace, within efficiency. And what I appreciated was that every other conference call, Mark Zuckerberg talked about efficiency, about lowering the headcount, about increasing productivity. Those were the things that I was looking for. I was not entirely sold on his leadership, but I did concede that, hey, he's saying the right things, and this continues to bolster our case for Meta. So that was fantastic for the year. So that is our recap and just of Q4 and a little bit of 2023 rather, for those who are not insiders. For those of you who are insiders, this is probably all secondhand information. So the good, let's talk about what's happening within 2024. So we're going to talk about the good, the bad, the ugly, and the opportunities. Overall, I think that 2024 is a constructive year, and we're going to get into that right now. So the good. Baseline expectations. Inflation will continue to track lower than the Fed expects for 2024. So right now we've been outpacing the inflation expectations, right? And what does that mean to anybody who's listening? That means as we get surprises, right? That's what triggered the markets in December. It wasn't just that inflation was coming down. It's that analysts were getting it wrong because they're looking at low frequency data. I often don't understand quite what they're looking at, but I break down exactly what I'm looking at to insiders. There's no, like I said, there's no hearsay. There's no crossing my fingers and maybe and called it, bro. None of that nonsense. And I try to be hard on that and mock it because I think it's so dangerous to finances, right? But sometimes you get lucky and take a guess and you're like, no, this is the great way to do it. Be informed. If it doesn't make sense, you don't have a reason, don't deploy your money. Don't deploy your capital. Your money is far too important. And that's the way to build wealth. Now, the baseline expectations are that we will continue to track ahead of expectations for the Fed, meaning the numbers are going to be lower than the Feds are anticipating. And the Feds are not going to only have to be more aggressive, meaning more frequent cuts, meaning bigger cuts, and meaning cutting sooner than expected. It could be any one of those three or a combination thereof. And I do expect that the cuts we get will be even bigger, if that isn't triggered even sooner by a black swan event, because there's still a lot of systemic risk that has not fully manifested. So the baseline case and expectations, we're going to continue to track lower, just like we did for November and December. And those tracking lower are part of why the markets exploded up and why the rates came down. Because I was showing you that chart on the TNX of rates coming down. Well, the Feds didn't slash rates. So if you're just trying to understand how the markets work and demystify it and get rid of all the furu nonsense out of your head, there's real reasons. As you see inflation coming down, the markets can begin to loosen conditions. That alone loosens conditions because we can say, hey, this is behind us and the Feds will be cutting. So inflation has and will be continue falling in two key components of inflation. And this is part of how we've calculated ahead of the markets. And we've done this all year long. And when I look across the industry, there are a handful of analysts who did this as well, or at least to some extent. Everybody has their own formulas a little bit different. But a lot of them just almost ate whatever the Feds were feeding them and got hooked on these old antiquated ideas, and they just couldn't time it right. I don't think they're looking at the data. We're going to continue to track lower and continue to keep falling because used autos as well as shelter is leading numbers lower with the potential for some strong deflationary components within inflation. And so what happens with used autos and what happens within shelter is those numbers lag. It's not that I can see through a crystal ball and I happen to be right, because you've seen all my predictions. I put things out in public. I work with insiders. We joke and I say, the robot, I made a call to the markets and they did what I wanted, or I looked into the crystal ball. But really, I break it down for everybody and say, look, here are the key components. We're seeing that used autos, this is the data coming off the lots. We know that this will reflect in 3 months. So then when we look at inflation numbers and say, look how heavy the calculation, the two key components to inflation are shelter and used autos. Well, if we see through higher frequency, that just means faster calculated data, that these have been coming down. It just hasn't been calculated by the Feds. It's a pretty clear indication that inflation will come down. So no crystal ball, but real economic work and understanding the markets. That's what professionals do. Financial easing. As inflation falls, conditions will ease across the board. So that means lower treasury yields, lower mortgages, stabilized costs, investor confidence, better S&P 500 profits, and more capital flowing from the sidelines into the markets as there's trillions of dollars parked on the sidelines from skeptical and tentative institutions and investors. And what I want to highlight here is you might think, well, how does lower mortgages help the markets? One of the biggest financial burdens on people are the cost of their mortgages, right? So lower mortgages, and I know that a lot of people are locked into low rates, but a lot of people are not. Lower mortgages and lower rates will help people. Stabilized costs will help people. Easing conditions across the board means more money for everybody. Lower payments on your credit card rates, lower payments on your student loans. Anything, any vehicle of debt loosens, it makes it easier for people. Plus, as costs come down, people spend more. And so that's going to drive S&P 500 profits. Like I said, I like to explain. If you don't like understanding what you're doing, probably not the guy for you. If you want to guesswork and play darts or go to a casino, that's not the way that I handle my money. But I have a career of success, whether it was being working in the capital markets, working with Fortune 50 when I was in my mid-20s, one of the youngest hires ever at P&G for a management position, becoming CEO at 29. I take things seriously. Makes me a little bit of a boring person, as I understand. That's the feedback that I get, but I take things seriously. So understanding is critical, and I will always explain. Expanding multiples. So what does that mean for the stock markets? When financial conditions ease, capital costs lower, and risk tolerance increases. This will bode well for markets and support higher valuations. Meaning, when you have more money, you can speculate with it, right? Expanding multiples. Am I willing to pay more for NVIDIA or Google or some other company? I could be a little bit more aggressive with my money. Why? Because my money isn't as scarce. My access to capital isn't as scarce. Capital costs are lower when I borrow, when I go on margin, when I take loans. Companies can have capital expenditures and not be as constrained. It's just much more of an open and fruitful environment. How do you know that? Look at any year when rates went up, markets went down. When rates started to ease and we started to see calming, markets went up. This year it's all about the anticipation forward. Remember, it's not that things need to happen. We need to be calculating and anticipating it. Just like we have been through this December rally, we saw surprises in CPI. The markets recalculated how the Feds are going to work with interest rates. And that's what I'm saying when I'm talking about expanding multiples. So we will pay more for companies and that will drive prices up. And timing is key. Not all of these items will occur in a linear sequences such that the markets have a chain of positive reactions. We'll discuss what we see in early 24 in the contrast to the back half. Guys, there will be periods of profit taking, particularly after really heavy rallies. But I'll discuss the points, the key levels. And when I talk about levels, I don't talk about them like a furu where I just draw a line on a page. No, I talk about it from a valuation standpoint. Because the way that we do that is we say, look, this is where rates are. This is what the markets are pricing in the next X number of months. Given the valuation of this company, is it in the right place? Is it in the wrong place? Is this somewhere where we're going to go neutral and maybe people want to take profits off the table? That's the secret formula. I get so many questions of, what's your formula? How do you do it? What indicator do you use? None of that nonsense. That's something that someone packages and sells to you in some sort of scam group. Here, buy my super indicator that I in my basement coded and outsmarts all of these multi-billion-dollar companies with algorithms and various analysts and hundreds of people working departments, but I've got the magic indicator. Check it out. No, you do it through work. Work on the underlying economic and understanding the markets as you see them. And most people won't, so that's how things work in any profession, right? You do things by being good. If you ask someone how to become a really good golfer, it wouldn't be buy the super magic club, right? And then use this indicator for when to swing the club or anything, or guitar. There's no magic secret. There are things that help and tools that help, and I pay for a lot of good subscriptions. You use Bloomberg, all kinds of tools, but there's no magic. You have to be really good and put in the work. So that's the results you get from playing guitar, golfing, or anything else. Same thing. So the good tailwinds for 2024. Let's add another one. Friendly Fed. Feds are no longer the market opponents as they have been up to now. I have been critical of the Feds. I think they've over-tightened. And there's not many ways out of that other than to spend and to ease. We'll talk more about that in a little while. But now the Feds are likely to have an unspoken mandate, and I'm positive that they do, to support the economy in 2024. Now, some people like using the term pump, boost, whatever you want. It's on. It's on for 2024. And so timing is critical. If you're looking at the markets and saying, hey, we're primed up for a crash or a pullback or a bear market, it's not that those things disappear. And we're going to talk a little bit about that later. It's you can offset them by spending. And that was part of what happened in 2023. And at the very end of this, with insiders, I'm going to go over a little bit from 2023 and talk about our expectations, but we did throughout the year. Being agile is very important. Bottom line here, we have a friendly Fed that will be supporting the markets, and we are likely to have an unspoken mandate to support the economy. President Biden is polling at 37, and he needs a boost, right? And now if you say, well, the Feds are independent. If you think that the Feds are independent, then I have some magic beans to sell you for a stock that you could climb to go get some gold from the clouds. They're not. If you have a boss that appoints you, if somebody appoints you and can remove you, you have a boss. That's it. That's not independent. You're responsible to someone? Yeah, you're not independent. Now, let's look at the stats, because what do the stats say? I'm data-driven. I don't care about politics. I'm not on team left. I'm not on team blue or team red. I know most people are. I don't care about all that. I care about being my boring, focused self and separating sort of political views. So what do we see? Well, in the fourth year, when a Democrat is the incumbent, the markets are generally plus 12.86%. We actually see a little bit more information on what we observe here on how the markets do. When a Democrat was in office and a Republican was elected, the total return was 12.9%. If you look at where we're trending, and there's a big asterisk here, we're trending towards that 12.9% because right now a Republican leads. The leading Republican candidate is ahead in the polls, and President Biden is suffering, but that's going to be good for the markets. We'll talk about that in just a moment. And if it's a Democrat elected, it's generally 11%. And so in all these election years, 11.28%. When Republicans elected, we see 15.3. We see previous years. There's some anomalies. There's the market crash. The last return was with President Trump in 2016, 12%. 2012, President Obama, 16%. And like I said, this is year 4, an incumbent Democrat, 12.86%. So you could work with that, or you can say, well, and a Republican was elected after that, 12.9%, if you're going based on the stats. Now, let's get back to this. 37%, President Biden needs a boost. And so what does it say? I'm not a big fan of looking at correlation statistics when you say, well, when this happened, if there's no tight correlation. And I'll explain that really quickly. You can look up and find all kinds of correlations. Like when it rains in Boston, there are more heart attacks in Florida. Okay, that's not necessarily a false statistic. That could actually be a correlation. I think I read something along those lines where it was like, when there's more pizza ordered in Tampa Bay, there's more car accidents that same day in Raleigh, North Carolina. Okay, that's a useless correlation, right? What does it mean when we look at presidential years? Well, people in power want to stay in power, and they will do what they need. Americans overwhelmingly state that the most important element for deciding on who to vote for is the economy. If you're not connecting the numbers here, or not connecting the dots, then let me help you. The most important thing is the economy, and you're trailing and doing very poorly, and you are the boss of the people who are in charge of the economy. The pressure is on to dress up the economy and do well. Now, that might sound like I'm supporting Team Blue or President Biden. No, that might sound like I'm supporting Team Red and saying, oh, they're pumping the economy. No, I don't care about any of that. I care about being accurate and providing analysis. That's why there's weight to this, because we can understand the why. Why do they do best in these years? Because it's critical, and you man it, and you're willing to pull out all the stops to ensure that you get reelected. This is serious. This is as big a business as there is in the world. You want to take the most important office in the entire world, arguably? Okay, well, the most important thing is the economy. Make sure that it's trending well and that it performs well going into elections, or you are guaranteed to lose. If we slump into a recession, the incumbent will lose. The incumbent is under a tremendous amount of pressure. And right now, this makes it even easier to read. Why? Because if President Biden was polling very high, we could say, okay, well, even if the economy does poorly, he's so well accepted that they might have the win anyhow. You don't have to pull out all the stops. You're already in a place, you're in a dire position with the economy as it is. You absolutely need a boost. That's why this is important. I don't care about which team. So if you're a Democrat or a Republican or whatever you are, this is not political. This is the art of, or the science of understanding the markets and understanding what to expect. So I expect the Feds to pull out all stops. And if we look at what the trend is in politics, the extent to which administrations will leverage their power to win and to squash their political opponents is unprecedented in history and what we're seeing nowadays. Like the gloves are off. There's no more hiding behind the scenes, right? They're willing to go as far as they need to go. It doesn't matter. And out in broad daylight, like we don't care. We'll put you in jail if we don't like you, whatever the case is. That bodes well for the markets. Not to sound unemotional or unsympathetic to either political side. I generally don't like politicians because I don't think they help anybody. I've met politicians. They're very good at telling you what you need to hear if you're on the left or on the right, whoever they represent. But they're really just trying to advance their careers. So it's, what kind of actor should I be? Should I feign that I'm sympathetic? Should I talk about point A, point B? I am my own way, and that's why I've never run for politics. The side rant here is, I'm my own way. The best way that I could help is to be accurate and help people understand the markets. I know I don't change the entire world, but at least I could be honest with people, which is everything, and help. And if that's what I could do here, then that's great. Because I think, and just to put a close on this, if everybody does better financially, that makes the world better. Probably still yell at each other and scream about our differences in politics, but you know what? You're a lot more stressed when you can't pay your bills and when you're struggling than when you're not. So if we could all just be a little bit better off financially, or even just to understand, have more knowledge, that's a way to heal the world, so to speak. What else do we have in terms of tailwinds? Landings and wages, a deferred landing situation, which is what I think is happening here. And I'm going to explain. The economy is in a lot of trouble. There's a lot of data that shows some really, really bad signs coming forward, whether it's debt to GDP ratio, whether we're looking at consumer debt, but you could defer it. You can defer by cutting rates, by spending, by pumping money into the economy, by running massive deficits. You could do it. So if we can defer this landing, right? That's what I call it. It's not a soft landing. Defer it will unleash suppressed demand, right? And if the plane can be propped up through 24 without, a black swan event or geopolitical events, a war, cyber attack, that will create a period where consumer demand will rise due to suppressed activity. people have been paring back, they will unleash, particularly as wages outpace inflation, and this creates real wage gains. So what we've had over the past number of years is inflation has outpaced wages. You've heard about that, right? So you're behind. Even if you make 5% more and everything costs 10% more, you're upside down when you look at the delta. Well, we had an inflection point not too long ago in 2023. We're now, in terms of we're looking at rates, wages are above inflation for the first time since early 2021. That means you're now starting to get ahead. Now, in the grand scheme of things, prices have gone up over the last few years. Yes, you took your lumps. But when we look at these rates, it's what's happening right now. That doesn't mean that eggs are going to drop from $6 to $4 and suddenly you're ahead. What it means is the rate of change for the price of eggs going up from $6 is slower than the rate of change for the average person's increase in their salary. That's good, right? So if year over year over year, you finally get to the point where it's like, oh, now things cost $10, but I'm making $12 more, right? So I'm ahead of the game. That's the idea. And so what we're seeing is wages are outpacing inflation, and this creates real wage gains. That's what a real wage gain is, right? Because if you're gaining in your wages, but things are becoming more expensive through inflation, then you're really losing. That's why we say real, because you're really losing. But if you're making more money you're increasing your salary at a rate such that you outpace inflation, you have real wage gains. And sectors and stock options. So we have a lot to look at and forecast, and we're about to get into that with my picks for 2024, different sectors that I'm interested in, some of the stocks, and we're just going to talk about a bevy of different items and what to look at in terms of risks and periods and all of that sort of thing. But I'm going to say that while we don't expect 20% gains on the S&P 500, the view is that 2024 will be flush with opportunities. And in this next portion, we're going to review specific sectors, indexes, stocks that we're bullish on in 2024, as well as important details this year will have weak periods and times of strength. Again, this is an overview, but we're going to narrow in on some items. So that's it for the free portion. Thank you for everybody who tuned in. I hope this was insightful. If you're not already don't already have the options trading book that I provide, it's 100% free. Just download it. Like I said, I don't want anything from anybody. I don't want any money. Just download it, 100% free. And you'll be on my mailing list as well. So I'll send you periodic little updates about the markets and various items. So thank you for being part of this. Insiders, stay tuned. We are going to move on from here.